Simple moving average, SMA. You can calculate the value of a simple moving average for any currency pair by adding the closing prices for a selected number of time periods and then dividing the result by the specified number of time periods. You'll discover that SMAs which deploy a smaller number of times frames will respond faster to price changes than their longer term counterparts. Consequently, you can consider the SMA as the average price of a currency pair over a selected time period. You must remember that the price of each time period has the same weighting as all the others. You can utilize the SMA to detect new price trends. For instance, a new bull trend is identified when the price closes above the SMA. Similarly, should the price drop below the SMA, then a new bear trend is in the process of being formed. The SMA can also provide you with the mean price over a certain number of previous time periods. For example, a 50-bar SMA would produce the mean closing price deduced from the last 50 time periods. Specifically, SMA values are calculated using the average closing price of a currency pair over the last X periods. For example, consider that the last 5 closing prices of your currency pairs were 92.40 plus 91.60 plus 90 plus 92.10 plus 93.90 equals 460. The SMA is now determined by dividing the total by the number of periods. That is, the 5-day SMA equals 460 divided by 5 equals 92. However, you should not try to trade SMA and price crossovers in order to achieve profits, because price will often surge above or below the SMA, only then to revert and proceed in its original direction. However, you should use the following rules to generate profits. 1. Identify those currency pairs that are displaying the power to generate strong SMA crossovers. 2. Test the 5, 10, 20, 40, 200 SMAs to determine the best candidate for tracking and monitoring price. 3. Once achieved, you should then develop a secondary confirmation technique to confirm a strong price crossover. This procedure will help prevent false entries caused by fake-outs and false signals. And 4. Enter the trade on the next bar.